It is Thirsty Thursday, 30 minutes until the start of trading. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, President Trump rattles stocks with potentially game-changing new policies targeting the housing and defense sectors.
And a green light for Nvidia. Sources say that China plans to improve some imports of its H200 chip for commercial use.
Plus, U.S. companies announced fewer layoffs last month, signaling some momentum for the labor market into the new year. What does that mean for the Fed?
So many questions. By the way, I was going to start with a check in Nvidia, but it's not really doing anything.
No.
It's up like 0.3% on that latest news, which you mentioned, which we'll get to in a moment with our Ed Ludlow. But what I wanted to show, Matt, which I think you'll be very excited about, is market cap of Google, of Alphabet, and Apple. Look at what's happening. Okay, so Apple is this orange line on top. At the bottom, you're looking at Alphabet. For the first time since 2019, you are looking at Alphabet overtaking the market cap. It speaks to this broader thing that's happening at the moment, Matt, where AI companies are doing really well. Alphabet has an AI strategy that's famously doing well. Well, Apple is famously
Exactly. And you know what? Yesterday, we didn't hit another all-time high in stocks. We only got to 69.20 because Apple and Facebook dragged us down, even though Nvidia and Google were pulling us higher. So we'll see how that tug of war works out today. Speaking of tugs of war, defense stocks are soaring after President Trump demanded a $500 billion increase in annual defense spending just hours after those defense stocks tanked because President Trump said they can't do stock buybacks or return cash to shareholders with dividends. So a little bit of a mixed message there for the market in terms of defense, Dani.
Yeah, and it speaks to a broader thing of Trump getting involved, at least to start the year and most of last year with corporate America. A mixed reaction, but Palmer Luckey, founder of private company Anduril, welcomed that strategy.
President Trump is saying that he wants to see defense companies building new plants, building new factories, delivering on time, and then maintaining systems cost effectively. And that's, trying to do more of that is why I started Anduril 8 years ago, because I looked at the United States defense industrial base and realized we weren't moving fast enough. We weren't building new plants. We weren't building the new technologies that we needed. And so I'd say I'm broadly aligned.
Here with us is Bloomberg Equities reporter Matthew Griffin. Matt, what a whipsaw of a day, because first you have all these roadblocks put up against corporate action, and then $500 billion is what Trump wants to add to the defense budget. So all in all, is this a good environment or a bad environment to be a defense company?
Well, investors and analysts are still making sense of that very question. I guess if you look at the pre-market stock reactions, you have Lockheed Martin up more than 6%, Northrop Grumman more than 7%. It seems like the initial knee-jerk reaction is this is, all things being equal, a good environment. But again, analysts have just been publishing lists of questions about what this means. What are the conditions where the government will move to limit buybacks? Will this kind of spending be able to be passed by Congress? And is there a tension between these two goals of increasing spending and also trying to incentivize companies to be more efficient?
Yeah, I'm looking at, the dividends. These companies have been returning significant cash to shareholders. Lockheed Martin has a $3.45 dividend. So is this going to be bad for income across the board, or maybe the boosted revenue is the better side of the picture?
Yes, again, knowing exactly where all of this nets out, it'll take some time to do the math. We have, though, some early numbers, some calculations from Jefferies. They say that if you look at the companies from the buybacks, actually, General Dynamics faces the biggest share downside. There's also a potential hit to Northrop if they don't do any buybacks in 2026-27. But the EPS upside from this increased spending could be really significant. So 11% for General Dynamics. 13% for Northrop Grumman. Those are not numbers, I think, to sneeze at.
Matthew Griffin covers defense for us on the BN side. I'm sure you're incredibly busy today, so really appreciate you taking the time to join us. President Trump also getting involved in corporate decisions. On the home building side, the president will seek Congress's help banning large institutional investors from buying single-family homes. in an attempt to give Americans a better shot at home ownership. Our markets correspondent, Nora Melinda, covers housing and joins us now. Nora, also in this case, we saw initially the shares absolutely tank, including, for example, Blackstone. Some of those shares have recovered.
We are certainly seeing a recovery when we look at the pre-market trade. But as you called out just yesterday, we were seeing real estate stocks plunging. I'm looking at Invitation Homes, American Homes for Rent. Those are both companies that focus on single-family rentals. So when you think about institutional investors, they're coming in, they're purchasing a home, flipping it and renting it out, hoping for, of course, rent increases in terms of prices, but additionally just long-term value. So essentially, when you think about the idea of the larger U.S. American home market, we've always been having this whole conversation, this debate about whether or not institutional investors are essentially creating some of these home affordability issues, or inaffordability issues, I should say. So, I mean, that's kind of what I've been talking to my sources about in recent days. I mean, I was talking to Hoya Capital. They were saying that they feel as though institutional investors have essentially been the convenient scapegoat to mask a lot of the underlying issues that we have in the U.S. home market. Some of the things that they talk about are years of underbuilding. We've also got restrictive zoning, as well as rising construction and financing costs. Those are all things that are really pressuring this U.S. market right now.
Yeah, I mean, there's some statistics. I'm looking one from John Burns Real Estate that institutional ownership of Blackstone in the market is 0.06% to single-family homes. And then the other institutional owners are 0.5%. So
absolutely,
it is minuscule. And, you know, Nora, I was also talking to sources about Blackstone particularly, who said that they could sell off these assets pretty easily. Home prices are high right now.
Right.
So it wouldn't be that big of a headache for them if they had to get rid of more of their exposure, which they have been doing. What about these other companies whose businesses are more focused around on them? I mean, it's maybe too early to say, but is there a game plan? What happens if you do get an outright ban?
Right. And that's what we've really been talking about. People on the street are really trying to figure out what is the next step here. I mean, for a lot of these companies, I talked about Invitation Homes and American Homes for Rent, they specialize in this. This is their entire business model. While a lot of them are finding ways to potentially pivot, of course, the question still remains whether or not this is actually going to become a law. Because, of course, these are all things that we're talking about in theory, as, you know, President Trump is trying to push for more affordability for the U.S. home buyer. But we have to see whether or not this turns into a legitimate law and it can pass through Congress, or maybe some sort of presidential executive order.
Well, in California, they might be doing something as well, with Gavin Newsom talking about the same exact measures.
I wouldn't be surprised if Zoran Mamdani does something similar.
Actually, it does sound like a policy
Yeah.
that might come from a Democratic socialist, something to consider. Nora, thank you very much. Nora Melinda on our Bloomberg Markets team. Let's now turn to a Bloomberg scoop. Matt mentioned it, that China will approve purchases of H200 chips as soon as this quarter. Here's what Nvidia CEO Jensen Huang said this week about his company's communications with Beijing.
I haven't spoken directly to them, but ultimately, the way they'll communicate to us will be through the companies. If the companies are allowed to buy Nvidia products in China, then there'll be strong demand.
Bloomberg Tech's Ed Ludlow conducted that interview from CES in Las Vegas, and he joins us now. And I'm having a hard time keeping up, if I'm being honest. The Information had a story yesterday that China was not allowing H200 chip sales. Now maybe they are. What do you make of the reporting coming out on this?
Yeah, and I know earlier you said, well, the stock's only up 0.3%, right? What I hear a lot from sources, both on the White House side and in industry, is let's wait until the first H200 actually ships, and there's evidence that it's made it to China, and then the market might see more of a reaction to bake it into the forecast. What we know from sources is that China is in a position where it still wants to safeguard its own domestic industry and champion its domestic players. But clusters of, say, 200,000 H200s for Alibaba and Baidu for commercial use are okay. What sources say China is absolutely not going to allow for is any use of the H200 in the military context, any use in sensitive industries, government agencies, state-backed enterprise. The reporting on Alibaba and Baidu's cluster of 200,000 is interesting. It's comparable, for example, with what XAI operates in its Colossus cluster. So the scale is there. And, you know, one thing that Jensen Huang did say this week is, you remember that prior forecast, $500 billion of sales over the next 5 fiscal quarters, Blackwell and Rubin, that number excluded China. And he did go as far early in the week as to say, actually, if that number were to get bigger, it would be because they expect H200 to be a contributor.
Ed, I want to ask you about, as usual, the last couple of days, you do tech, but you also do media. I want to ask you about Paramount because there are headlines crossing the terminal. They have reaffirmed the same bid that Warner Brothers officially rejected yesterday at $30 a share. And I heard Geetha Ranganathan say, maybe they just really can't make the math work to pay more because they're already going to be incredibly leveraged here at this level. So what should we know about these headlines crossing right now?
Yeah, and it's difficult to interpret an 0.8% decline in Warner Brothers in the pre-market. Is it a surprise that Paramount comes back and reaffirms the same bid? No, because they've been consistently arguing that they think it represents a premium over the value of the cable networks. We discussed this yesterday, right? The difference between the Netflix and Paramount bids is Paramount wants the whole enchilada, which would include legacy cable, whereas Netflix proposes to spin it off. One thing we didn't discuss is within the structure of the Paramount proposal, there are some restrictions placed on Warner Brothers in their ability to basically do business in the interim. Make investments are capped, which, Warner Brothers Discovery in its pushback of Paramount's deal said, you're stopping us from doing anything. So that might be a part of it. But, clearly, Netflix is Warner Brothers' focus right now. And the conversation we've had here in CES, particularly there's a lot of advertisers here, right? And from the consumer standpoint, they tend to say that, yeah, the Netflix proposal makes more sense.
Yeah, and the financing is so interesting as part of this, Ed, with Paramount saying our bid is 100% cash and definitely completely certain. I mean, for Warner Brothers Discovery, Ed, it sounds like their concern isn't whether it's cash or stock. It's how much debt financing are you going to need to do in order to get the cash necessary for this deal?
So I think this is really interesting, and if the audience has a view on it, I'd love to hear from you. The way that Warner Brothers Discovery framed it was this is a really big or the biggest leveraged buyout in a negative context. But they also noted in their response that the sort of backstop that Larry Ellison is playing here. Right, Larry Ellison is basically, and Dani, jump in and save me. I can't think of the term right now, but he's the guarantor, right, of the deal going through. And when I read the Bloomberg story and indeed the original document, I couldn't tell, were they talking about Larry Ellison being the backstop in a negative context alongside the debt concern, or as a positive, in the pro and con column? But clearly it's a lot of debt.
I think it's fair to say that he's the backstop, Ed. I mean, that's certainly true. And again, it does sound like Warner Brothers Discovery just is the debt pile. The biggest, as you said, the biggest leveraged buyout in history is what they're claiming. Ed, excellent reporting. You're in Las Vegas at CES. Looking forward to your continued reporting there throughout the week. Let's get a check on futures this morning after a decline yesterday. For U.S. policy-dominated market moves, we're down 0.1% for the S&P 500, so another high remains elusive with the NASDAQ 100 futures and small caps underperforming. Small caps down, Matt, more than 1/3%.
Let's get a look at some of the other individual movers in the pre-market as we count you down to the opening bell. Jefferies posted a drop in quarterly profit due to a $30 million pre-tax loss tied to the collapse of auto parts supplier First Brands. $30 million loss. They probably have multiple employees who get paid more than that. Costco climbing. The nation's largest warehouse club operator reported total comparable sales for December that beat estimates, largely because Lisa Mateo links two carts together every time she goes shopping there.
Wow, that's a good workout.
And the world's top gold producer, Newmont Mining, cut first quarter output expectations because a wildfire damaged a key mine in Australia. As a result, those shares down 2.33%.
Coming up on the show, some positive signs are emerging in the labor market. We're going to break down the latest data ahead of the big one, tomorrow's jobs report. That's coming up. We speak with Bloomberg's Michael McKee. This is Bloomberg.
Getting out of high interest to look at what's making headlines around the world. An ICE officer fatally shot a woman during an operation in Minneapolis, igniting protests and sharp political backlash. Federal officials called it self-defense, but city leaders dispute that claim, and you can watch the video yourself. It was caught by a bystander, and that video has been widely shared on social media and on news platforms. It has intensified the national debate over the Trump administration's expanded immigration enforcement attempts. And over 1,000 companies are suing to recover billions of dollars in duties paid under President Trump's tariffs as the Supreme Court prepares to rule. Major brands including Costco and Goodyear joined the rush after justices signaled doubts about the president's authority here. A loss for the administration could trigger a massive fight over refunds that may be complex to dole out. A decision could come as soon as tomorrow. And Federal Reserve Governor Stephen Miran says cutting rates by 1.5 points this year, by 150 basis points this year, could put up to 1 million Americans back to work. He argues the Fed doesn't need to be as restrictive as he thinks it currently is at these levels because the labor market is softening. He spoke with Bloomberg Television in an exclusive interview.
We're still materially above neutral in my mind, and there's not really a reason to be materially above neutral if the labor market is in a weakening path and inflation is an underlying inflation's already running close to our target and on trajectory to hit the target. There's just not a real reason to be so restrictive, and we're running unnecessary risks on the labor market by being so restrictive.
Let's stay with labor because U.S. companies announced fewer layoffs last month while planning to hire more. That's according to the latest Challenger data. At the same time, we also got weekly jobless claims that rose less than expected. Joining us now is Michael McKee, Bloomberg's international economics and policy correspondent. Mike, it's not just those two pieces of data. It's also ADP that looked good, JOLTS better than expected too. Is this a labor market that's holding up even better than expected?
Well, I think that it is probably holding up. Whether it's better than expected or not depends on your view of the government shutdown and whether the data are giving us a true picture. We will get tomorrow in the payrolls report some revisions to the prior months, and we'll see where we are. But as you can see, initial jobless claims very low, 208,000 after 200,000 the week before. But these were holiday weeks, Christmas and New Year's, so they may not tell us a lot about what is really going on in the claims area. The productivity numbers are good news in the sense that they are disinflationary. Companies can make more money, but then they may not need to hire quite as many people. So at this point, we're kind of keeping an eye on the labor market. It's not collapsing, but certainly the data we've gotten so far are not making the case for Stephen Miran's 150 basis point cut.
I have heard, Mike, other economists say that rates at these levels are, in fact, at least a little bit restrictive. How is that measured beyond the noisy, bumpy data we've gotten on labor? Because it does seem like a lot of parts of this economy are doing very well while we may be in a manufacturing recession.
Well, we may be. That was something that happened back in 2015 when oil prices fell so low that oil companies stopped investing and we had a bit of a manufacturing recession. The issue is you can't really tell what neutral is, except in hindsight. As Jay Powell said, we know it by its works. And so the idea that inflation is not coming down would suggest you're either at neutral or that you're a little below it, a little stimulative. And we'll see what happens with that next week when we get the CPI numbers. In terms of whether or not the Fed has gone far enough, that's a big argument right now on the Fed. About half of them think that we're close to neutral, and another half think that we are not there yet, and they could cut more. And then Stephen Miran thinks we could cut a whole lot more.
Yeah, 150 basis points this year. Mike, thanks very much. Bloomberg's Michael McKee, our international economics and policy correspondent. Coming up on this program, as the U.S. government dictates more and more of what corporate America can and cannot do, Ann Berry says she is following one specific trail of money on Wall Street. We'll tell you what that is when we come back. This is Bloomberg Open Interest.
New Year optimism in stocks is giving way to jitters about the economy and politics. Traders are trying to figure out Trump's latest edicts on defense and corporate landlords, with the whirlwind of headlines making things more, or at least feel more, unpredictable as usual. Then we also have a huge day tomorrow with the latest jobs report and a potential Supreme Court ruling on tariffs. Joining us now is Threadneedle Ventures founder Ann Berry. So just like a super chill start.
Yes, easing into the year.
Exactly. Look, with the latest missives of Trump posting on X or making new executive orders about defense companies, it's not new Trump's involvement in corporate America. To what degree do you monitor it, gameplay it? Is there a playbook for it, or is it noise?
I don't think it's noise, because I do think there's signs of real attempts to shift policy in the sectors that are real estate and in defense. So I pay attention to it and I monitor it. But try and play to game it, no. And it's similar to the situation in Venezuela. I think you sort of see these signs coming, and then you've got to try and take stock to see how the data unfolds over a period of time. I mean, you said it. What does it mean for this to be enacted, right? When you've got statements about defense sector executives needing their compensation capped, for example, which was one of the complaints that the president had with respect to that sector. So you've got to wait and see. Unfortunately, you've got to wait and see.
I mean, he did also indicate that he's going to be spending more, and clearly this is a president really interested in taking military action overseas. Yes. Which is contrary to what we may have thought at the beginning of his term during his campaign. But can you bet on defense companies? Because even if their CEOs aren't getting paid that much, they're going to be raking in the revenue.
So I did bet on defense companies. Right before the inauguration, right, there was a lot of conversation, again, what does the Trump trade look like? And the Trump trade was defense, it was healthcare, and it was financials. And as I look at 2026 and see what's unfolding, I do think a lot of those things are coming to fruition. I do think it's defense, because I think, yes, Matt, we are going to see more spending. I think that's been very clear from the start of this year. So when it comes to financials, I think we're going to see a big wave of deregulation. So I think going into these, but just being willing to sit through a bumpy ride is key.
All right, we teased that you are following one specific money trail at the start of the year. We didn't say what it is yet.
Oh, okay, yes.
And so we're going to hold that for when we come back after this break. Ann Berry is staying with us. This is Bloomberg. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We are looking at futures off just a little bit ahead of the opening bell. We closed the cash trade at 69.20 yesterday, which is only 25 points away from an all-time high. So we're up there on the S&P. We're up there on the NASDAQ. And the Russell has, by the way, outperformed these other two benchmark indexes since Liberation Day. Ringing the bell at the New York Stock Exchange. You can't miss him. Dan Ives. And his ETF, Ives is the ticker, is up 30% since it started trading in, I think, early June, maybe late May. So he's done very well, and it's very colorful. As a result, they're really happy, obviously, ringing the opening bell. SunOpta ringing the opening bell down at the NASDAQ Stock Exchange.
Zero color.
They're not as colorful. And actually, the stock has lost half of its value over the last 12 months. Over the last 5 years, it's lost 70%. So they're less excited, I think, and less colorful, because they just haven't, well, they've lost a lot of money.
And I'm assuming they don't have a Dan Ives type who likes to dress in highlighter.
Maybe they need to get him over there.
What a great corporate strategy. Matt, here at the opening bell, I'm looking at a monumental shift that happened at the close yesterday that's been ongoing, and that is Google parent Alphabet becoming bigger than Apple for the first time since 2019. Its market cap is something like $3.89 billion, whereas Apple's is a trillion. Sorry, that's a big difference. 3.89 trillion, and Apple is somewhere around 3.85. Just given the divergence in today's price action, up 1 1/3, down 1 1/3, that gap is only growing more now, Matt.
Google is bigger than Apple.
Yeah.
Sure, Ed Ludlow and Caroline Hyde will be talking about that a lot on Bloomberg Tech. We are focused on defense stocks here on Open Interest. Yesterday, tanking, no pun intended. This morning, they are soaring. This is because President Trump, well, one of the things that he's done is demand a $500 billion increase in annual defense spending. But he also said he was going to block defense companies from stock buybacks and dividends, from returning money to shareholders, from paying their CEOs whatever the owners of the company have voted to pay the CEOs. So effectively moving in with the heavy hand of big government. And I don't know, is that a positive or a negative for defense stocks? They're already so closely linked with the swamp. Let's bring back in Threadneedle Ventures founder Ann Berry. And we've talked already about defense. I guess we could get to housing. But I did want to tell our viewers what you're following. There's one specific trail that you're apparently following to kick off 2026. What is it?
I am. It's the activist hedge funds. And this is why, in a market that is this expensive, trying to find value is very difficult. And so following the money, where they wake up every single morning, they do a ton of work, they do a ton of diligence to find a way to build a position in the company where they can go create value, becomes very interesting to me. Look, I grew up in private equity, and you take a long-term view. You're
nice
willing.
Place to grow up.
Thank you very much. Yeah, it's a skill set that you get, which is to really go deep into understanding the operations of a business, look for ways in which to do bold things, buy businesses to add on, sell divisions, think about new products, even if it means it's going to be a drain on your cash flow initially. And I think the activists are moving much more aggressively into deploying that kind of mindset, and they're not shy. 25 was a busy year, actually, for the activists. I think 26 is going to be even busier.
So what have you seen specifically from some of this activist action that's interested you, that you've either added or thought about adding?
So there are a couple of different sectors, but I'll give you one example because I thought the thesis was particularly interesting. Starboard built a position in Fluor, which is a construction company. Low-margin businesses construction, typically very difficult because you've got lots of projects, so there's a lumpiness to it. But what they said is, look, buried inside this business, Fluor's got a stake in a small modular nuclear business, and you should take a look at the sum of the parts and understand that once that position becomes more and more lucrative, you're basically buying into construction at a much lower multiple than you would anywhere else. That, to me, was an example of creative thinking. We'll see if it pans out. But that's a position that I did add actually. I thought.
By the way, do you comb through these? I mean, Fluor, I wouldn't think of as a nuclear play.
And it's not.
Whereas
It's just got that investment
Cat,
side.
I wouldn't think of as an AI play.
Yes.
Or, you know, any of the other AI plays.
Well, Cat's a bit different because I do think that there's something out there when it comes to the AI. We're all overexposed, right, when it comes to the big tech companies.
I believe it. I'm just saying you don't normally think of it like that,
You
right?
shift mindset.
Yeah.
You shift mindset.
I mean, Deere could be an AI.
Well, I think it is. I think these hardware companies, we're going to have to see an upgrade in the cycles. Are going to have to adapt. Yeah.
In another sector, we're about to get a whole slate of bank earnings coming next week.
Yes.
Financials have hit new highs as of this week. Is there more room to run?
I think in some of the names there are. So if I take a look at names I hold already, like Goldman Sachs, like JP Morgan, we've already seen big run-ups there. Where I'm interested are in two in particular, Bank of America and in Citi, because I think those two names still have room to go in terms of getting the benefit of the scale of their balance sheets. Citi, we know, has been really focused on getting more operating leverage. It's now seen it saw a great run up in 2025. I think it's got more to go. Deregulation, relaxation in capital requirements, those two are trading at a multiple of book value that's significantly lower than the JP Morgans and the Goldmans. And I think they both have an opportunity to step up and take some share when it comes to these lucrative M&A mandates, these lucrative equity capital market mandates as well.
I don't know how to make the pivot, but fun. Six Flags is a stock that you like.
Yeah.
And I think it's so interesting to look at the consumer, and people use the term K-shaped economy.
Yeah.
But obviously the rich are getting richer and the poor are not.
Yeah.
Why do you like this stock, which, by the way, over the last 5 years is down 62%? Maybe that's a reason in itself.
Yeah, so this is the product of a merger, right? There were these two theme park companies that came together. The integration has gone exceptionally poorly. An activist has taken a stake. Jana Partners has gone in. Dani, we were just talking before the cameras rolled. Yes, Travis Kelce seems to be around it. But look,
I did ask you if Travis Kelce was your
thesis. That wasn't the catalyst for me. There is clearly something to do here around the real estate portfolio, number one. I think, Matt, to your point, the wealthy are going to Disney theme parks, right? The wealthy are spending money on experiences. The lower income demographics are also looking for experiences, and Six Flags is one place that is still an opportunity to them. It's the value place that you can go and take your family. That being said, these theme parks are tired, right? They frankly look a little bit cheesy. The strategy has been to tweak around the edges with mildly better beverage offerings. Something fundamentally has to be done there, but I think done well and executed well, there's upside.
So you think, in 2026, this summer, is Six Flags the place to go? Should we all be visiting a park here?
Well, why don't the three of us go?
Great.
And we can come back and we tell
You're a roller
everyone how
coasters
it goes.
person in?
I can take a roller coaster.
I'm going to Disney in February. I'm dreading it.
Well, you're
already,
the bougie. Well, you're the bougie end of the
Well,
spectrum.
I
going
have
to
a
Disney.
5-year-old, so and she cares about princesses, so I have to take her there, regardless of the money and the sort of income inequality and the horrible thing that I'm doing for society. But maybe Six Flags is a more, egalitarian.
It's the Disney of the people.
Experience.
It's more accessible.
Wally World
It's more
for the rest of us.
More accessible.
All right, we'll leave it there before this gets completely off the racket. And thank you so much for joining us. That's Threadneedle Ventures founder Ann Berry. Okay, a check on markets about 8 minutes into your trading day. Look, markets are a little bit pressured from the fact we have been getting better jobs numbers. So that means bond yields have been rising. That's putting a downward pressure overall on these equity markets. We're only down 0.06% this morning. I pointed this out at the open that Alphabet is having an excellent run today. It has been having an excellent run over the past few months, and its gain today 1%, and its close yesterday means that it's now bigger than Apple for the first time since 2019. And as fate would have it, the biggest loser in terms of points taken away from the S&P 500 is Apple today. That's followed by Nvidia, down 0.6%, even though Bloomberg's reporting that China is allowing H200 chip sales to go into China unless you are a company that has to do with national security issues. Let's look at what the sectors are doing this morning. It's industrials and energy doing well. We still are seeing a lot of those the energy providers when it comes to building, like Halliburton, those are doing really well. Again, part of Trump's aim in order to have Venezuela restart their oil fields. Industrials are doing well because a lot of the defense companies, with a raise of $500 billion is what Trump wants added to the defense budget. Infotech, materials, those are some of the worst performers this morning, Matt.
All right, so let's look at what the markets are doing right at the market open. Coming up, we get Bloomberg Intelligence's take on President Trump's market-moving announcements targeting the housing and defense sectors. We're going to dig into both of these sectors separately with experts from BI. Stay with us for that. This is Open Interest.
About 15 minutes into your trading day, let's look at some of the top calls, what analysts are upgrading and downgrading. First up, Alphabet, that gets upgraded to a buy at Cantor Fitzgerald. The firm says its decades-long investments have created a powerful AI moat that should translate into stronger monetization as regulatory pressure eases and AI becomes more practical. Those shares up, they were up 1%, now up just 0.6%. Next up, Needham is cutting Nike, saying that the turnaround is dragging and execution risks are rising. They say that Nike is pushing too much product into U.S. retailers without enough brand demand, while problems in China and at Converse remain unsolved. Those shares down 0.8%. Finally, JP Morgan, they downgrade Alcoa to a sell, saying the stock's valuation looks stretched after recent outperformance. They prefer copper over aluminum, considering copper has hit new highs. They also believe that Alcoa's risk reward is now skewed negative despite ongoing cost and efficiency improvements. Matt, those shares down 5.5% this morning.
All right, let's turn back to the defense sector. President Trump demanding a $500 billion jump in annual defense spending, while threatening to cut out some companies that would profit from that boost if they don't make the policy moves that he wants them to, and if they continue to give money back to shareholders. Joining us now is George Ferguson, Bloomberg Intelligence Senior Defense and Aerospace, as well as our airlines analyst. George, there's a lot for you to do. Like, I imagine you were probably in the office until midnight and came in this morning at 5. So what are we to divine from these tweets?
Like you said, usually defense is a little bit slow and maybe sometimes boring, but it hasn't been the last 24 hours. So I don't know. We're unpacking them right now, right? And I guess maybe if we start at a $1.5 trillion defense budget, they got to get Congress to go along, right? Last time I checked, Congress had the power of the purse. I guess even if they were willing to spend $1.5 trillion, I don't know how you get it all done in a year, right? I think that Right now, we're even at a $1 trillion defense budget. We've talked to Lockheed. The president tweeted about this yesterday, or talked about this yesterday. They pushed Lockheed to build more PAC-3 interceptors. We need these for good air defense. Lockheed's going to expand their factories. They're going to go from 600 to 2,000. They'll have it done by 2030, right? So, I mean, the lag on a lot of these defense products is a long time. They're heavy industrial products. So that $1.5 trillion, it sounds like a great number. I'd love to see it passed, right? Definitely stocks are moving on it today. It's going to be hard to execute on that in year one. And I guess when we look at the industry, and this dovetails into the dividend, share buybacks, and CapEx tweets that Trump has made, right? This is an industry that goes through political ups and downs. And so you can imagine these companies are always a bit reticent to put a lot of money into CapEx, their own money into CapEx, their shareholders' money into CapEx, and find out one president later we'll be back to $750 billion worth of spend, and all of a sudden they're shuttering factories. So, I mean, that's another challenge if you're an investor, if you're a management team, is how persistent do you think $1.5 trillion spend will be? I have a hard time seeing it wedged into the U.S. budget. It's going to be really challenging. Maybe you could surge there for a year or two. These are things I think that are going through management teams right now.
Well, those efforts, be it more money, more of the budget from the president, from this administration and Congress, or be it capping or freezing, rather, dividends and buybacks, George, it's part of what you were saying, that there is this supply chain issue, and Trump has said in this, specifically calling out Raytheon, saying that you need to be able to produce faster, and that's the issue here. Would something like freezing buybacks and dividends and putting that back into production, would that help at all to solve the problem that Trump is trying to call out?
It's a stick, right? It's a stick.
Yeah, I see the stick. I get it. But Raytheon, Boeing are another interesting sort of, look at how this could have problems, right? So then, look, if you're running a defense business with a commercial business next door to it, and you're getting synergies, like, Raytheon RTX makes commercial jet engines. They make jet engines for the U.S. military. There's clearly some synergies there. If you can't reward your shareholders with buybacks and dividends, and look, these are not explosive growth companies, right? It's not like Apple, and wake up tomorrow, they've got the next killer product and revenue's going through the roof, profitability is going through the roof. These are slow and steady kind of companies. If you can't reward your shareholders with dividends and buybacks, then maybe you need to separate the commercial side of this business from the defense side of this business. Do we want to do that? Don't we want those synergies inside those businesses? So I don't know that restricting, buybacks and dividends. I don't think buybacks are always the best way to deploy capital, but I don't know that restricting it is fair, especially again, to the shareholders. You want shareholders involved with these companies, right? And so I don't see this being a big fix.
To some extent, management are shareholders, right? And so you're saying, like, dude,
Usually.
You can't pay yourself either salary or in buybacks or dividends unless you do what I want you to do in terms of production. So that's where I see, his logic.
Yeah.
But what do I know?
Yeah, and you want the best CEOs
plenty,
possible for these companies, right? You want the best
Very
CEOs
true.
possible.
Very
You don't
true.
want to be limited.
Hey, George, thank you so much for joining us on this. George Ferguson of Bloomberg Intelligence. I'm sure this conversation is not going away. Now, in the flurry of messages, of truths, of edicts, maybe edicts to come coming from the president yesterday, one was on single-family housing. You can see what happened to Blackstone yesterday. They plunged on Trump's push to end corporate home buying. They've since moderated. It recovered from that dip, though, is still down over the past 3 days. Let's bring in Bloomberg Intelligence REIT's senior analyst, Jeff Langbaum. It wasn't just Blackstone, to be clear, Jeff. It was a lot of these institutional home buyers. We can talk about the effect on the companies themselves. First, I want to talk about the policy. Connor Sen, Bloomberg opinion columnist, had this really good piece basically saying all this would do is restrict supply, which is not good for pricing. Going after institutional home buyers, Jeff, what effect would it have on the overall single-family housing market?
Yeah, I think Connor's piece nailed it. This is a great political message in a year of midterms to sound off against the big institutional bully and speak in favor of people who are, struggling with affordability. But the end result probably, well, first of all, it's unclear what he'll actually be able to do. But secondly, it's unclear what the result of it would actually be, because, if buyers come out of the market, then production probably does fall. I mean, it's the same kind of message that we hear around, rent caps and things like that, where, it sounds great, pricing won't go up, but
Corn laws.
all it does is thwart inventory.
Yeah, I mean, I don't know if in my economic history, my free market capitalist upbringing, I've always thought that where there is less regulation, prices will find a lower floor, right? I mean, we regulate clothing very little. We regulate food fairly little, and they're very cheap. Whereas housing, we tend to regulate the hell out of it, and it's become a huge problem. And I get that, socialists and populists think that they can govern by edict and lower prices, but it never seems to work. From the corn laws in England to today, it just doesn't work. Or am I wrong, Jeff?
Well, and oh, by the way, renting is a lot more affordable than buying a home right now. So I understand the push to improve pricing on home buying, but if you're doing it by squeezing landlords who are offering a more affordable option, that's not necessarily conducive either.
All right, Jeff, I'm going to be definitely looking at your research for guidance here. Bloomberg Intelligence senior analyst Jeff Langbaum covers housing, and we'll see what actually comes of these tweets. Obviously, you get a few calls from big institutional home buyers, and maybe. Well,
I was going to say,
change your mind.
Steve Schwartzman, an ally of the president.
He's the man I was thinking
of. An advisor.
Yeah.
I'd assume he'd be at Davos, and President Trump said that he's going to unveil more of this policy on housing at Davos. Maybe the two have a meeting beforehand.
Right. Well, I mean, the global elite get together there, but maybe that's not a way to win votes, right? And as you said, also, Blackstone, they don't really
minuscule.
They don't really need to be in this business.
Yeah.
Coming up, we break down Jefferies' earnings, which are weighing down the shares. Right now, 5% ahead of the other big bank earnings. This is Open Interest.
Jefferies posted a drop in quarterly profit due to a $30 million pre-tax loss tied to the collapse of auto parts supplier First Brands. It's the first read on the banking sector as more bank earnings roll in next week. Let's bring in Bloomberg Intelligence financials analyst Neil Sipes. Neil, clearly the stock is selling off because of it. I mean, Matt kind of hinted at this earlier, like $30 million. Rich Handler probably gets paid more than that in most years. Just how big of a black eye is it for Jefferies?
Yeah, look, I think we're still working through the fallout of the whole First Brands sort of ordeal. That's in bankruptcy proceedings. Obviously, there's questions around fraud there. Most of the exposure here for Jefferies stems through a small equity stake within one of their asset management funds that was heavily invested in some of those First Brand receivables. Ultimately, the $30 million, it's less than 1% of tangible capital here at Jefferies, so small in that sense. And the $30 million compares with $43 million in exposure that they disclosed earlier in October. So
from First Brands, which is idiosyncratic, right? And one of the reasons we care about Jefferies is that it often tells us how the other big banks are going to do. They're the starting gun for big bank earnings. How do you read this report when you're looking for earnings from Goldman Sachs and JP Morgan?
Yeah, I think it's largely in line of what expectations were, right? Which was a continued build in capital markets momentum, still resilient and, at decade high levels of trading revenue. And sort of, I think what the expectation most important for Jefferies and looking at the big names like Goldman and Morgan Stanley coming in the next week is that 2026 is generally expected to be better than this year, right? 2025 was a tale of two halves, right? We had the first half uneven, Liberation Day, et cetera. That put a lot of pause on deal making and capital raising. Second half, we saw a lot of momentum, 4Q particularly strong for M&A. And when you look at expectations for 26, there's actually faster revenue growth and faster fee growth ahead that we think.
All right, we're going to be talking more about that, Neil. Neil Sipes there from Bloomberg Intelligence on Jefferies and what it means for the rest of the banks. We're going to talk technicals when we come back with technicals legend, Marianne Bartels. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger, on track for a second consecutive day of declines after earlier hitting a record, now weighed down by higher bond yields.
Coming up, President Trump rattles stocks with potentially game-changing new policies tweeted out on the housing and defense sectors.
Geopolitics remain high on the agenda. We're going to get insight from Nicholas Burns, a man with deep experience in managing global tensions.
Plus, corporate and private equity deal makers express optimism about the year ahead. We just heard that from Neil Sipes. We'll get now the outlook from GTCR's Collin Roche and Bob Profusek of Jones Day.
We begin with caution on Wall Street. Ann Berry of Threadneedle Ventures weighed in on uncertainty in markets.
To see these signs coming, and then you've got to try and take stock to see how the data unfolds over a period of time. I mean, you said it. What does it mean for this to be enacted, right? When you've got statements about defense sector executives needing their compensation capped, for example, which was one of the complaints that the president had with respect to that sector. So you've got to wait and see. Unfortunately, you've got to wait and see.
Joining us here at the desk is Miran Bartels, Sanctuary Wealth Chief Investment Strategist. And I always want to ask you about technicals because, you know, I grew up watching and reading your technicals analysis, and so did so many of our viewers. But obviously you have a take on the fundamentals as well, and today we need that, right? Because we got so many messages yesterday from the Trump administration about how the president wants corporations to allocate capital, and he wants to make those decisions for shareholders. How do you see, you know, what he wants defense companies to do, what he wants housing to accomplish?
Well, I really don't get involved in the politics when I'm trying to figure out the markets. When there's a lot going on, and especially stressful things like what just happened in Venezuela, what I try to remind clients is we have to look at what's the impact to corporate earnings. Is there an impact to corporate earnings? And if there's an impact to corporate earnings, then we're going to have a market move. In this particular case, everything that's going on has not yet affected corporate earnings. Now, in terms of the original statements by President Trump about not being able to pay dividends, that could impact, you know, corporate earnings, right? Or, you know, pay scales. So you saw the stocks go down, but then the next announcement came out that maybe defense spending should be higher, and that positively affects earnings, and we saw the stocks go up. So at the end of the day, whatever is happening, you want to ask, how does it impact corporate earnings? And at least at this point, I don't see a negative impact to corporate earnings for the market, or at least right now, not for the defense companies.
Well, but he's got a carrot and a stick, right? And in some ways, in a lot of ways, the one big beautiful bill was a huge carrot, and so is this suggestion of higher revenue. The stick is, you know, the dictates on buybacks and dividends and CEO pay. And what we're trying to do this morning is weigh out, you know, how they net.
I think the net is overall it's going to be positive. And even when I look at the technicals of the stocks, defense stocks have been in a bull market. I've always said when at war, you want to own defense stocks. And we still have a lot of military action going on. We have a lot of spending come out of Germany. Germany is going to be spending over the next 10 years $500 billion on defense. So I think the defense budgets for these companies over the next 10 years is going to be very positive. So if we take a long-term view, it's positive for earnings. And when I look at the technical, it's positive. And when you have both of them lined up, it's a win-win.
Also says something to have a war portfolio when we're not technically at war, Mary. We'll leave that there. One of the other things, though, is you could maybe analyze, or some of these policies good or bad for earnings, but what about just the unknown whether the policy gets enacted with housing specifically? Invitation Homes sold off, Blackstone hold off, some of the home builders sold off. But we don't actually know if this policy will come to fruition, a ban on institutional buying in single-family homes. So what do you do when there's a clear impact, but you just don't know whether the policy will actually happen?
Well, again, you go back to fundamentals and you can go to the technicals. When I look at the home building stocks, I'm not interested. You know, it's not that I would sell them, but I don't want to buy them. And I don't think we know the impact until we have definitive answers on what the policy will be. We don't know, because obviously some of the private companies that are public were negatively impacted that have exposure. So you really have to wait to see what is that policy to really determine what the fundamental impact will be on those companies. But you said we're not at war. Technically, we're not at war, but we are supplying military equipment to the Ukraine. And that's bullish for our defense companies.
You have not only been recognized by industry publications like institutional investors, but you for your technical analysis, but you also have proprietary methods. How do you look at the start of 2026? Because we hear all of these stock traders' almanac things, like about the Santa rally or the first 5 days of January, but they don't seem as serious as the work that you do.
They're fun. I look at them.
Yeah.
You know, the January effect. We're all going to see what the January effect has. And some of the probabilities are high. But at the end of the day, I really go back to my roots. And my roots are really looking at how do the charts read in terms of the technicals. And then I do a lot of quantitative work on earnings. And the power of the earnings, at least right now, is still coming from tech AI companies. And I still find them technically to be the leadership within the market. But as we open up the year, we're starting to get, it's not so much a rotation, but a broadening out. We're getting other pockets of the market to do well. And that's actually very bullish longer term. But when I look at price momentum indicators, they're weakening. And that's why I think we're seeing a very choppy open to the year, is that we can have a sideways trading. Maybe we get a pullback, but any kind of pullback we see as a refresh to allow the markets to actually rally. But as you know, a lot of talk about the midterms and the volatility during the midterms, and that traditionally happens between April and September. And I think we can have a lot of volatility, just like we opened up this year. And I don't know if you've talked about the fire horse of this year in Chinese astrology, but it's going to be the year of the fire horse.
I have not. You're the first person to tell me that.
Now, you don't have official Chinese New Year until February 17th, but I feel like the fire horse energy is already here. We have a lot going on, and I think that's going to continue for the rest of the year.
A very auspicious year. I love that. Mary, what about when it comes to price momentum for metals, for copper, for silver, for gold, that had a huge run in 2025? And continue on that path for the start of this year?
I've been, as you know, very bullish, particularly gold and the metals. I continue to remain very bullish, and particularly on the stocks. I think for investors, if they're questioning whether or not they want to have exposure, I think it's still very early innings for the metal stocks. They're in a new secular bull market. So, everything is pointing to that these stocks will not only go up this year, but there's a good chance that they're going to go up for the next couple of years.
What about the dogs of the Dow? How does the fire horse treat those dogs?
The dogs, that term sounds terrible, right? But it's dividends over growth. And I love the dogs of the Dow. Last year, no one's talking about them, which is one of the reasons why I like it. Last year, the dogs of the Dow were up 19% on a total return basis. So what you do is you take the 10 highest yielding stocks at the end of the year, and you hold them and you collect the dividends. And I think in a year that we're going to have some volatility, owning stocks with dividends is going to be a good strategy to add some ballast to a portfolio.
If they're allowed to pay those dividends, right? If you get an executive order saying they can't.
That's just defense stocks.
Okay.
At least as far as I know, that's just defense stocks.
Thank you so much for joining us this morning. Such a pleasure to have you. Marianne Bartels of Sanctuary Wealth. Matt, some of the movers that we're watching this morning. Alphabet, as of the close yesterday, and it continues today, it has overtaken Apple to become the second most valuable company by market cap. It is the first time that's happened since 2019.
We're watching shares of Nvidia as well, following our reporting that China plans to approve some imports of the company's H200 chips as soon as this quarter, and there have been a lot of back and forth stories on this. So I'm not sure how much faith investors are putting into that.
The information reporting yesterday that China was not allowing sales of these chips. And we've been talking about it all morning. Defense stocks soaring after President Trump demanded a $500 billion increase in annual defense spending, a 50% increase, just hours after blocking defense companies from stock buybacks and dividends. Let's get more out of Washington with Bloomberg senior editor Michael Shepard. Shep, it's back to this environment of a fire hose of information and edicts from President Trump. Just focusing on housing and defense companies, what can the president himself actually get done, and what needs approval from Congress, for example, so is less likely to actually come to fruition?
Well, it is a fire hose indeed over the past day in terms of what is going to hit these two major sectors of the economy, defense and information technology on one side and housing, and even the investment side too, because he is taking aim at the institutional holders of rental housing across the country. On housing, Dani, it really remains to be seen what his plan will entail. He took aim at a part of the market that has been blamed in the past for perhaps having a role in jacking up housing prices and perhaps limiting availability, but there are so many other factors involved. And a lot of those big institutional players in more recent years have started to step back from that. He plans to unveil more on his housing affordability approach at Davos, of all places. It's a curious location to be talking about something that pertains so directly to the American voter during a midterm election year. But we will see what that means, if it looks like an executive order or perhaps more like legislation. And we did see Republican Senator Bernie Moreno of Ohio introduce a measure yesterday, shortly after the president's Truth Social post, saying that, look, we will try to codify what the president just put forth. Now, when it comes to defense stocks, he actually did sign an order on that, codifying it as a regulation, something that will be enforced by the Secretary of Defense within 30 days. We'll start hearing from Pete Hegseth about whether companies are keeping up with what is expected in terms of production and research and development. Two of the carrots that the president is holding out as objectives for the companies to try to achieve before they feel the stick of any sort of restriction on buybacks. And then, Dani, when you ask about Congress's role, well, they're going to have a big say on that $500 billion increase in defense spending. Congress may look at that and think, whoa, we are in deficit reduction mode here. Over the next 10 years, that would amount to $5.8 trillion in added spending potentially.
Hey, what do we hear from the Democrats or Democratic socialists on this? Is Gavin Newsom on board with President Trump's policy? Is Zohran Mamdani on board with President Trump's policy? And how advisable or how concerning is it that these two sides would join forces?
Well, in a way, Matt, what we heard yesterday from the president really echoed something that Democratic Senator Elizabeth Warren, one of his arch enemies here in Washington, has been calling for years, and that is trying to get larger investors out of the single-family home market so that more people can find it more affordable. And she has been saying this for years, calling for this kind of proposal for years. And yet, of course, as she also has acknowledged, and other Democrats too, this is only one part of the problem. The larger issue is supply and, of course, the interest rate question too. Interest rates are higher. Housing supply is lower. We have seen the Case-Shiller index since 2020 rise 68% in terms of housing costs. So there are a lot of ways that they would like to take this on. The president is choosing just one here, and Democrats will be looking for other ways to bring this issue forward as the midterms near.
Yeah, but California Governor Gavin Newsom also calling for a similar crackdown too. Mike, thank you so much for joining us. Bloomberg's Mike Shepard. Coming up, we're going to talk private equity. Collin Roche, co-CEO of GTCR, a PE firm that manages $50 billion in assets, is joining us next. You're watching Bloomberg Open Interest.
The gauntlet for approving investments at Apollo has gotten higher and higher over the last year or so, as we see an environment that down the fairway, I'll use a golf analogy, down the fairway, you've got a lot of great things going on. The rough, where there's lots of challenges, between geopolitics, between the concern about inflation, between the concern about the return of invested capital in AI, there's a variety of left tail items that have certainly grown in stature.
Apollo President Jim Zelter, full of metaphors this morning, speaking on Bloomberg about navigating the current macro environment. I'm pleased to say joining us now is Collin Roche, co-CEO and managing director of GTCR, a PE firm that manages $50 billion in assets. Collin, thanks so much for joining.
Thanks for having me.
Is it the same for you? Do you see something different about this current environment that makes you want to be maybe not outright cautious, but at least more selective?
Well, we've been very active. So we've been speaking with our pocketbooks, so to speak, both on the liquidity side, but also on the investing side. We had an all-time high in terms of new investments last year. And while there's risk of disruption from AI, there's policy issues, et cetera, we also find it to be a very attractive investing environment, starting with the fact that it's a more fair pricing environment. In an environment like this, there are sectors that are overvalued in private equity, but by and large, prices have reset to more reasonable values where the LBO math works, or where if you buy a business at a fair price and you improve the business, you can drive an attractive return. I think people tend to underappreciate risk when markets are frothy and then over-interpret risks in environments like this where there's such an active news cycle. We like this environment much better than, for instance, 21, which was absolutely the worst year to invest in private equity, but there was ebullience in that environment. So we try to go against the tide a little bit, and we hope this is an active year just like the last couple.
Dani, what was the T-shirt you saw with DPI?
Oh, DPI is the new IRR.
Yeah. And it's a driver, right, of everything you do. Obviously, has always been, but how important is it now when you look at exits, for example?
Well, our industry lost track of that, candidly. I mean, we saw this massive...
And by the way, it's distributions to paid-in capital.
Yes. So our responsibility as investors is to take commitments from our institutional LPs, invest those into companies, ultimately sell those companies and turn them into cash. That got deprioritized over the years, really beginning right after the financial crisis when we had low rates, low returns on other investments, and there was a massive inflow, increased allocation to private equity. So what happened? Prices kept going up. You had a leveraged beta phenomenon where if you were just a leveraged owner of private equity assets, you could do well. And the focus on value creation and getting liquidity went down. That all reached a crescendo in 21 and turned in 22. And since then, our industry's been rationalizing. Our responsibility as investors is to always be returning more cash than we're taking in. So GTCR consistently has produced more cash from prior investments than we're actually investing. And why? Because we're producing gains on those investments. So the proceeds on our gains can outstrip the amount of growth in our business and the new investments.
It's, in a way, simple but profound at the same time.
I think we're Chicago-based and we keep focused on the fundamentals, and there's some basics of our industry. Pay fair prices, work with great people, know your industries, but also drive value creation, and then have the discipline to be realistic about when you should achieve exits. Our industry lost sight of that a little bit, so now there's this kind of logjam of deals, backlog of companies that haven't been sold. And now we're 3+ years into this, right? I mean, the cycle turned in early 22, mid 22. Here we are in early 26, still talking about when is this backlog of deals going to be cleared. I think
because too many other owners are waiting for like the dream scenario to sell.
If you overpaid and then you didn't drive value creation, are you going to sell? And in our business, when you sell, you don't redeploy that capital. You send it back to your LPs. We're not hedge funds. We're not those kind of structures. So the incentive has been in our industry to play for optionality. Oh, there'll be a better market that will come around next year or the next year. But that's been going on for multiple years, and LPs, as you point out, are focused on, we need to get cash back to commit to your next fund. If we don't get cash back, we won't commit to your next fund. There's a lot of firms in our industry that are under that rubric right now. And then there's a subset of firms like ourselves, and we're not alone, that have been more disciplined and have produced a lot of cash. Last year, we produced more than $8 billion in cash liquidity and some other deals that have rolled into this year. So now we have more than $3 billion of near-term liquidity pending. If you keep doing that, your LPs, and there's the good returns that go along with that, LPs are happy and will recommit.
One of the, I think, more amusing stats from last year was this thing someone from KKR said, Allison Wood, that there are more private equity funds than there are McDonald's. I mean, the number's in the thousands. So as sort of this proverbial pig makes its way through the python and people are saddled with assets that they paid too much for, are we going to see that number dramatically shrink? Are there going to be a lot of zombie firms out there who are just unable to raise new capital because they can't return?
Yeah, those exist today. Those exist today. And I would say our experience in the marketplace when we're competing to buy a business, it's a much narrower set of firms that we are competing with. 21 was, again, an all-time high. There was the tourists or firms you'd never heard of or got sponsored by some LP. fundless sponsors, et cetera, that were paying big prices. But you don't see that today. You see a small cadre of long-established, typically firms like ourselves. We've been around since 1980, but we tend to see a lot of the same firms that have the disciplines we have the focus. And again, that's good for our asset class to have that rationalization. The problem in private equity is it doesn't rationalize quickly because you have committed capital over many years. So these funds tend to last. They don't really go out of business. They just kind of fade away.
Collin, before we let you go, when we were getting all these pronouncements from President Trump about different industries he's targeting, I was kind of cross-referencing it with your portfolio. I'm like, defense companies, no. Real estate, no. That's not there either. Collin, in just a minute here, is that a coincidence or is that design? You're not exposed to policy-sensitive
No, I mean, it's purposeful. And again, 45 years of history, we've learned a lot of things. We used to take a lot more healthcare reimbursement risk, for instance, than we take today. So we've evolved. I'd say first and foremost, we take a lot of execution risk. So we are changing our companies dramatically. And if you're taking a lot of those risks, which you have more control over, you want to take less risks that you don't have control over, exogenous risks. So we've been purposeful in that. And I'd say there's a news cycle that every day there's some new thing that people get worked up about. What we're more focused on are what are the exposures across our portfolio.
Right.
If you look through how much supply chain risk, tariff risk, tax risk, stroke of the pen legislative risk, and we've been
trying to reduce that.
Yes.
Yeah. Collin, we're going to have to end it there. Thank you so much for joining. Please come back again soon.
Right.
Collin Roche of GTCR.
Thank you.
Let's get a check on the markets here. The S&P turning positive here at 69.23. The Nasdaq down 0.5%, and the U.S. 10-year yield at 4.17, creeping up to 4.18. Coming up, major IPOs are expected to hit the market this year. As we've been talking about for the last couple of days, we'll speak with Bob Profusek next, Jones Day Global Chair of M&A.
2025 was a tricky year. There were a lot of headwinds. You started with, you had tariffs, you had Doge, you had an environment where people really didn't know the direction of travel around interest rates and inflation. And so, at least as it related to IPOs, there was a little bit of a risk off from investors wanting to invest in IPOs. 2026 is going to be set up for a very good year, both within private equity and just corporate M&A in general.
That was Carlisle's Steve Wise speaking with us about his outlook for M&A and the IPO market in 2026. For more perspective, we welcome Bob Profusek, probably the most legendary perspective we can get on M&A from a law firm. He's the global chair of M&A at Jones Day. I really appreciate you giving us your time today. I guess every year people probably say, what's your outlook for this year and how's M&A look? But it does feel like we've built some momentum in 2025 for 2026.
Yeah, 2025 was the year of the mega deal. There were lots and lots of them. It pushed the total deal volume up over $4 trillion for the year. That's a lot. That's as much as we've had since immediate post-pandemic period. On the other hand, there were some things that were slow. I didn't catch the whole interview before, but private equity wasn't particularly active last year. Now, part of that is, candor, equity prices going up so much. It's, they tend to be inversely involved in things. But private equity's waking up, and they got to invest that capital. So it is a very busy environment right now. For the same reason, really, that the stock markets are up. There's a sense of optimism. There's tons of cash around. There's financing available for almost anything.
Less
and
regulation?
If you're a seller, is it going to get better? Maybe.
But one of the ironic things about it is when we had Steve Wise of Carlyle on, he was like, well, our Medline IPO, the reason it was delayed, we wanted to do it in the first half and we couldn't because of Liberation Day and it upset everything. Policy pronouncements from the president, which maybe not as seismic as that time he brought out that board with all those huge tariff levels, maybe not to that level, but he's still every day saying defense companies can't issue dividends, institutional investors can't invest in housing. The policy volatility is still there. Is that still impacting deals? Is it still slowing things down?
There is an unpredictability that comes from Area Code 202 that's like nothing we've ever witnessed before. It just is. And people are getting a little bit used to it, I think. And And there is this, this sense that it's more bluster than reality sometimes. But, the tariffs are still real. I mean, obviously, we've got to go through the court process here, actually right around the corner. But if it's not that, it'll be something different. I think Blackstone stock was down like 4% yesterday because of a comment about housing. I mean, who in the heck has been thinking about that, right? I mean, you're right.
Well, Elizabeth Warren has been thinking about it. Gavin Newsom has been thinking about it and making similar policy statements.
Yeah.
Zoran Mamdani has been thinking about it.
But this is the president of the United States. Like, in all candor, where's the jurisdiction here? So to be a lawyer about it, what's the role of the federal government?
Don't you have to throw that kind of traditional thinking out the window, Bob?
Yeah, to some degree. You've got to take that into account. And we're all fixated on the United States. There's a lot going on outside the United States. It's not quite so. There's not quite so much focus on it. But we were talking earlier. It used to be that if you did a deal with a business that was at least kind of global, you had a little bit of stuff you had to worry about outside the United States. Now it's not uncommon to have dozens of filings outside the United States.
So like legal issues, regulations,
and it's not
red tape.
And Make America Great Again, that resonates in a lot of countries about their ability to influence what's going on, and sometimes they do it in a way that you think this doesn't feel right. So there's a lot to it, and the fact that government has just front and center on M&A activity and other stuff, it's different.
Isn't that a big issue for even just the one very classic model of private equity is you take something that works in one country and you expand it globally, or you do M&A globally to try to give yourself more exposure. If all of that has more friction or maybe is outright impossible because you're getting pushback from other countries, is that an issue for like this very tried and true model for a big part of the industry?
Oh, yeah, of course. Yes, for sure. The economy, globalized in the last 25 years, no question about it. This is at odds with that in many key respects. Now, is it going to turn the tide? I don't think so, because it's not borders and stuff. We live in a connected world. Everybody can't do everything. But it's a factor, and there is a lot of friction on this stuff. On the other hand, stand back from it. Look at how much capital is available. You talk to Carlyle. I have no idea how much they have under management, but it's lots. We have 4 investment firms which have multi-trillion dollars in just index funds. So there's just so much capital. And that, I think, is a big factor here. It's driving it. It means that when new ideas come up, like AI and all these other things, they can be capitalized. Sometimes they don't work out. Look at all the money we spent on, the certainty of electrification versus fossil fuels. Well, that didn't work out so well.
We heard yesterday there are $3.7 trillion in portfolio companies owned by private equity right now. I want to ask about a specific industry, and that is near and dear to my heart, automotive. Because the EV play in automotive was like a market darling and has now obviously become a huge money loser. What happens in that area where so many companies, Ford just wrote down $20 billion, where so many companies have put so much assets investment and they're going to have to now wipe it away?
Yeah, and there was assumptions on all aspects of it. If you're in the component side of it, you're thinking, well, this is my opportunity for new business, because dealing with the big 3, if you're a component manufacturer, that's tough, and you get a contract, and then the price goes down, down, down with every year. Even though you're on the platform for 5 to 10 years, the profitability goes down. So it was great, for a while, but it's not going away. Electrification is not going away. It's just not replacing everything. The idea that it was going to replace all that stuff, well, that was not a good idea in the first place. But people still need transportation. The world, more and more people need transportation as economies develop. And electrification isn't over. It's just different. Now, one of the things that I thought is really rather remarkable is that sort of the grand person of this industry, Elon Musk, if you look at his proxy statement, where's the cars in there? It's all robots, you know. So we're already moving to a different idea. That's sort of a declaration of not surrender, but evolution of this. But it's not over. It's just going to be different. That's the issue. That's part of the issue with being the way we are in terms of communications. We jump from one conclusion to another, and the answers are usually much more subtle. Much more subtle.
I feel like we need to this copy paste, things aren't over, it's just different. This was like a therapy session, Bob. I think we all needed this. Thank you so much for joining. You're one of the best. That's Bob Profusek of Jones Day Global. Coming up, Nicholas Burns, former U.S. ambassador to both NATO and China, joins us to discuss part of what we've just been talking about, a new world order under President Trump. This is Bloomberg.
The acquisition of Greenland by the United States is not a new idea. This is something that presidents dating back to the 1800s have said is advantageous for America's national security. The president has been very open and clear with all of you and with the world that he views it in the best interest of the United States to deter Russian and Chinese aggression in the Arctic region.
And that was White House Press Secretary Caroline Leavitt. Her comments come as U.S. officials scramble for new business and diplomatic options to deepen ties with Greenland after President Trump revived calls to take over the island. Joe Doe, Bloomberg economic statecraft reporter, joins us now. Joe, so we all talked yesterday about this.
Yeah.
And it does appear that, well, we have a military base there, and we want to remain, in control of that. But also, there are a lot of rare earth minerals that we maybe want to dig in and get. What's been the repercussions of all of the talk on Greenland yesterday?
Well, the obvious repercussions are you've sent Danish officials, NATO officials into a bit of a maybe the word is just scurry, right? The president of the United States starts talking about this, and obviously they have to react. I think we were saying yesterday, on the one hand, Donald Trump, our president, is a little loose with his words, but European officials still kind of act in the way that typical Western officials have since post-World War II, right? Which is we take words seriously regardless of whether or not they're just an empty threat or not. So those are the clear repercussions. I think what we're trying to figure out is what is actually going on here. The president out of nowhere mentions Greenland over the weekend amidst questions of the Venezuela situation going on. And the reporting that we had out last night was, according to sources, was that these comments from the president around Greenland were unexpected by people within the White House. And since then, there has been movement to try to put together either deals or some other sort of policy or plans to start fulfilling some sort of idea from the president of the United States. I think the point is that it's not very clear, right? And what it reminded me of, and according to my sources and a number of other people I've talked to, is the chaos within the White House that we have been used to, but maybe really haven't thought of in the past few months. Like, out of nowhere, let's start talking about tariffs on copper, right? And then everybody kind of moves to try and satisfy the words of the president of the United States. On some level, I think that's what's happening here. And to be clear, one of the things we had in our reporting is, according to our sources, force is not on the table here. And I know we've heard a number of people come out and say that, both within Congress and, of course, the special envoy to Greenland, Governor Landry of Louisiana. But we are also having our sources saying that is not on the table. I think that's an important thing to really stress here, because we have been talking about NATO.
Okay, force isn't on the table, but something else.
Force is on the table, I think, right? They've said military.
The president has said out loud, nothing is off the table. Okay. But I am saying that, according to our sources, force is not being seriously considered.
But does it change, given just what happened in Venezuela, the seriousness that we need to take the president's word, just given the huge action that they took just last weekend, which, by the way, feels like a lifetime ago already?
Yeah, listen, I think we have learned in the first 4 years of the first Trump administration and now a year into this Trump administration that you take everything seriously. We do the best we can to try and parse the words of the president. And we try to do the best we can to parse what's actually happening with the discussions behind the scenes within the White House. I don't think there's anyone in NATO or Danish officials who are not taking him seriously. At the same time, I think it is important to understand that conversations in the background, and we've had this on the record from people on the Hill, and we've had this on the record from Governor Landry, that force is not on the table. We also heard Stephen Miller say, well, why would we have to use force? Now, you can parse that in the ways that you want to, but those are important to remember and then to try and parse what's happening behind the scenes. All of that said, you're right. Like, we should take all of this seriously. We shouldn't just sit back and say, well, he's just saying that. But we are trying to do the best we can to spell out to markets and to broader audiences maybe what's really happening behind the scenes, especially given we only heard Greenland come up 5 days ago. We hadn't heard about Greenland since the summer.
Yeah, it's a good point, Joe. Always wonderful to have you on. That is Bloomberg's Joe Doe. And let's get more on President Trump's push for Greenland. Joining us now is Nicholas Burns, a former U.S. ambassador to NATO. He's also a former U.S. ambassador to China and a professor at the Harvard Kennedy School. And Nicholas, there is no one else we'd want to talk with you about this subject. Because of your vast amount of experience, with NATO specifically, after this happened, after the latest pronouncements from the president, the Danish prime minister said that an attack on Greenland would spell the end of the NATO alliance. Just how under tension and how at risk is this alliance at the moment?
Well, certainly an attack by the United States against Denmark over Greenland would end NATO as we know it. It's been unthinkable since NATO was created in 1949 that the United States or any other NATO country would attack a fellow member. We've been busy trying to, of course, contain Soviet power and now President Putin's power in Europe. That's the focal point of NATO. And to get back to what was said, Secretary Rubio said when he was asked yesterday in the context of Greenland, is force on the table? And he said, well, he didn't point to force, but he said the president reserves the right to use force if necessary. Caroline Leavitt, the president's spokesperson, said the evening before, force was on the table on Greenland. Now, I actually agree with your correspondent. I think the probability of an American attack on Greenland is not high. But the fact that the president and the Secretary of State and the spokesperson have all said it is on the table, you can imagine how that's gone down in Denmark and in Europe. And so I think the critical point is this. The United States does not need to invade Greenland or to even seek to purchase Greenland from Denmark to get what President Trump has said he wants to have. The Danish Prime Minister has said throughout this year that she welcomes a further, bigger American military presence on Greenland. They welcome, the Danes, American private investment or government investment in rare earth mining and mining for other critical materials. So we can get what we want without these really colossal threats, colossally ignorant threats against a NATO ally. We just have to treat that ally respectfully. And I think in that respect, it is positive that Secretary Rubio is going to meet the Danish foreign minister next week in Washington. Much better for them to discuss this privately than this continued war of words started by the administration in Washington.
Professor, we are also hearing, and we reported yesterday, that Danish and Greenlandic officials will be meeting with Secretary Rubio next week as well. I am wondering, what do you think, I mean, with your vast experience in this meeting, is this the kind of thing that gives comfort to NATO officials? Is this the kind of thing that gives comfort to the markets? Or is the potential for more chaos ahead?
I just can't imagine a decision by the President of the United States to invade Greenland and to, in essence, cause an act of war against a NATO ally. So I do think that's low probability. And, the thing here is that Greenland is strategically important. If you think about Greenland's geographic position vis-a-vis the Russian Federation and where much of the Russian military assets are, which is in the western part, in Murmansk and other places of the Russian Federation. Think about China's ambitions, as they call themselves a near Arctic power. The administration is right, as President Biden said as well, that Greenland is very important strategically. We're going to be much better positioned to get what we want and to build up American military power in Greenland if we work through our ally Denmark and with the other northern members of the NATO alliance. We are all like-minded. We want to contain Russian power. We want to keep China out of this hemisphere strategically and prevent the Chinese from building up their power. And the best way to do that is not to dissolve NATO and break NATO apart by an American military invasion, but to go back to Greenland. And with the Danes establish a much stronger American military presence.
What if what the president wants, I'm sure that he wants to maintain military dominance over certainly China and Russia as well. But what if he also wants to mine Greenland's natural resources and so that we can keep them for ourselves and that we do not have to share them with other NATO members? I mean, is that potentially why he wants Greenland, so they can have the Earth there?
Well, the president hasn't been, at least in my judgment, that specific, so I don't want to put words in his mouth. But look,
but he does seem to want the oil in Venezuela. That seems to be the oil seems to be at least partially a driver in Venezuela, and now we know after he has arrested the illegitimate or not president of Venezuela, he has now said that they're going to give us 50 million barrels of oil.
Well, the two situations are very different. Maduro was illegitimate. Venezuela is not a military ally of the United States. Denmark is. Denmark has been with us since the First World War, by the way. And the United States said during the First World War, and we repeated that when NATO was created, we respect Danish sovereignty in Greenland. The Danes have been there for more than 300 years. That is not our property. So if anyone in the administration is thinking that the real reason for this is to mine rare earths and other minerals and oil and gas in Greenland and take it all from ourselves, well, that would be larceny. That would be highway robbery. It's unthinkable that the United States would want to live in a world where there are no rules and that, in fact, we try to exploit the resources of NATO members against their will. Now, this is a hypothetical conversation. I'm not saying, you asked the question, I'm not saying that the Trump administration wants to do this. I can't believe that many members, if any at all, of the United States Senate would support that. So that's hypothetical. What's real is that we used to have 17 military bases in Greenland, and now we have one. So if we want to have additional military bases, that can happen with the assistance of Denmark. And that's by far the better route for the United States to take here.
Ambassador, to go back to your point on the national security part here, right? So part of this is the Western Hemisphere national security strategy. A number of people we've talked to have discussed this around Greenland and Venezuela, kind of in some ways being connected. But you did mention the heightened activity within the Arctic Circle, Chinese ships, Russian ships. Can you maybe spell out, because there's a lot of sensible people who say, oh, this is an overreaction. Do you see that as heightened activity to the point where the United States does have to start paying attention to it in a way that it probably hasn't in the previous decades?
Well, certainly the Russians are acting and planning that they want to be the dominant power in the Arctic. And obviously we need to counter that. And President Obama, President George W. Bush, President Obama, and President Biden, as well as President Trump in his first term, all acted on that. That we're in the Arctic Council. We've been working with our Arctic allies, now Finland and Sweden and Denmark and Canada, to try to counteract what the Russians are doing. The Chinese are a different case. They're not an Arctic power. They used to tell me that we're a near Arctic power. I say, well, look at the map. You're not an Arctic power, but they believe they are. They're working with the Russians. And if you think about the fact that there's going to be this northern passage through the Arctic, at least in the summer months, that is consequential commercially, both for business, but also for energy flows. And so we do face a challenge in the Arctic. Greenland is strategically important. President Trump is not wrong about that, but there's a way to go about this, and that's to work through allies. And frankly, I should tell you, both as ambassador to NATO and also as ambassador to China, we are always stronger working with our treaty allies to contain Russian and Chinese power than trying to do it on our own, or in this case, threatening the use of military force. It just doesn't make sense for us to do that.
Hey, Ambassador, just quickly here, what happens with China next? They certainly, as you point out, have lost face in this whole thing, given their close partnership to Venezuela. We've had Peter Scheer from Academy saying that they have an army of lawyers that they might deploy. They also have the cudgel of rare earth materials. What levers can they pull to try to turn this around? In just a minute here, Professor.
I think the Chinese have lost face, certainly, because Venezuela was, in effect, a client state in many ways of China, and China could do nothing to prevent what the U.S. military did last weekend. Second, the Chinese want to continue to be the major trade partner of South America, and that's a really unfortunate reality for the United States. 20 years ago, America was a leading trade partner with nearly everybody. Now China is. So I think strategically, our aim should be much stronger American investment, private investment, and government activity in South America, in Central America, to counteract what I think is a very negative dynamic, and that is China's more influential than we are, unfortunately, economically. So that's the route that President Biden was trying to take, and I hope it's the route that President Trump will take.
All right, Ambassador, really appreciate your time. Thank you so much for joining us. Nicholas Burns there of the Harvard Kennedy School. This is Bloomberg.